So, hello everyone. I hope everyone is back. So, today we are going to resume the topic, and today we are going to resume the topic from RBI. So, RBI plays a very important role because since it's the central bank of our country, and central banks play a very important role. But the main question that should come in your mind: who decides and who influences the monetary policy? And what should be the link between the fiscal policy and monetary policy? Means, is there some kind of link in between, or what could be the inclination towards? Means they should be, converging in the same path, or should they have different paths, or should they go hand in hand, or should they have different, you can say, philosophies behind making these policies? So what goes behind the scenes, and what happens when we are unable to make a good monetary policy and a fiscal policy? Means, how a country or how economy pays for that. The first question that comes into mind: is RBI autonomous body? Means, why this question is being asked is that, though as I told you, monetary policy is being made by RBI, but is RBI really autonomous so that it can decide all the factors? So I have few examples on this, right? Now, the examples for this is that I told you monetary policy is for money supply. So whatever will increase money supply, monetary policy will try to curb that. But what if in fiscal policy government tends to increase the money supply? Then it will become very difficult for RBI. Means it is just, you can say, I am eating a medicine which is giving me side effects. है ना? And these side effects has to be controlled by RBI. So what is happening? Government is doing such kind of activities which is increasing money supply and which is further increasing the inflation, and this makes the job of RBI really very difficult, because now RBI has to take the burden of government actions, and RBI has to control the inflation as well. So first of all, let's see RBI and government as two different entities, and both the entities are having different objectives and different principles for sustenance. For example, government's objective is to stay in power. Government objective is to come back in power after 5 years. And to stay in power and to sustain that chair, and to come back again in power after 5 years after the elections, government needs to make people happy, because people gives vote to the government. And to make people happy, government take many decisions which can, we can say, basically increase the money supply, and which can impact the economy in a big way. Now, let's see how it works. Government can forgive the loans of farmers. Government can sometimes forgive the loans of businessmen as well. So forgiving the loans, it increases NPAs for the banks, and it becomes burden for RBI. Now, RBI has to maintain good health of the banking system, and RBI have to make the loans more strict, whereas government tends to make loans easy, and government tend to forgive loans. Now, what I meant when I said easy loans: government wants that many people takes loan. For example, businessmen take more and more loans so they can employ more and more people. They start more startups, more industries. And if the loan become easy, there are more chances of loans to become NPAs. So these things are quite contrary, quite opposite to each other. Government is trying to make loans easy. RBI is trying to make loan policies more strict. Secondly, more NPAs are forgiven by government, whereas RBI is strictly against NPAs. Last, you can say, since 2014, 14,000 crore rupee, has been infused three times to just prevent banking NPAs. Just imagine, three times government has infused 14,000 crore rupees in last 10 years under the this mission Indradhanush, to wipe out the NPAs. But don't you think infusing this money by the government will increase NPAs, and further it will increase the inflation rate? Now, It's the government who decides to print the currency, whereas RBI is very strict against printing the currency. The government will print the currency to fulfill their needs, to fulfill the money supply demand, and to fulfill their you can say day-to-day expenses. But over here, the one thing that comes into play, RBI is strictly against all these things. But government does all these things to gain political mileage, to make people happy basically. And this is not good for economy. This is not good for you can say money supply and inflation. So if I say the acts of government are basically those acts which makes the job of RBI bit more difficult basically, because at the end, it's the RBI who will be answerable for the inflation of the country. It's the RBI who will be answerable to make the policies, monetary policies. Now, let's see what is the role of RBI. RBI tends to control the inflation by the monetary policy that we already know. So RBI tends to avoid NPs. So it will try to make the loan policies more strict. RBI will be, hesitant, will be reluctant to print more and more currency, whereas government will be happy to print more currency. RBI will be, RBI will be reluctant to give loans to big businessmen who may run away taking the money to another countries. Whereas government will be happy to give loan to the businessmen because these businessmen only fund the elections, right? So the thing is that RBI government means fiscal policy and monetary policy sometimes doesn't go hand in hand. But on contrary, they should have the same direction for the growth of the nation. So that is why there should be a relation. So that is why in the recent example, if I tell you, demonetization is the best example. When demonetization took place, it was a statement given by the RBI governor that he was unaware of this fact. Just imagine, guys, the entire economy was stirred. Entire economy was really shaken because of that one decision, and RBI was not involved. It's strange. It's strange, and the impacts of demonetization is even till today we can feel that. Government forgive the loans of farmers. Government sometimes forgive the loans of government give loan waivers to farmers to businessmen. But RBI is the one who has to face the outcomes for that. Similarly, there is huge pressure on the governors of RBI in terms of decision making. That is why you might have heard so many governors have resigned their jobs in the previous times. That is why what I wanted to say that it's RBI is semi-autonomous body. Day-to-day activities they take independent decisions, but when it comes to monetary policy, yes, there is involvement of government and there is influence of government as well. I hope you got the point, everybody. So if you have any doubts, feel free to ask. So what I wanted to say over here, yes, RBI is autonomous, but not completely. For many decisions, there is influence of the government. Now coming to the next questions, printing of the currency. Guys, the question was that can government print currency? Yes, government can print currency. Can the governments of the can all countries print their own currency? Yes, definitely. All the governments of all the countries they can print their currencies. Now, the second question is can you print currency the way you like, when you like? Yes, absolutely. USA did it in last 10 years. USA had printed a lot of dollars basically. So we are coming to that, what crisis will come if you print a lot of currency. So can government fulfill the short-term needs by printing currency? Absolutely. So who decides to print currency? Is it RBI or Government of India? It is decided by Government of India, but it is printed by RBI. So decision maker is the government, and RBI has to follow the instructions. So decided by the Government of India and printed by the RBI. So any backup kept for the currency printing. See guys, for this we need to understand something. Currency printing, we have presses. We have a printing press where the currency is printed. So government can print currency any point of time. But if excessive amount of currency will be printed, I told you it will increase the money supply. If the money supply will increase, the inflation will really rise up. So it is not advisable to print a lot of currency, but still government does that. I told you government has to make people happy. And to make people happy, government needs funds. And there are multiple ways to raise funds that we are going to discuss. Government raise funds by bonds, government securities, and multiple other tools. But yes, printing currency is also one of that. Few years back, you know, to print currency, there was we used to had a proportional reserve system. Means if I had to print 100 rupee, then to print that 100 rupee, I had to keep 100 rupee gold, real gold, as a backup. So this was a mandate. So if I had to print 2 lakh rupee few years back, then I had to keep as a backup 2 lakh rupee worth gold with the central bank. And this process was followed throughout the world. And it was a good process. Means government had a mandate. So government was not having a free hand to print as much they wanted. So government had to buy gold. But it had some drawbacks. Means it increased the import of the gold, it increased the prices of the gold, right? And it was sometimes very difficult to maintain that much amount of gold, right? So next system, and it was a check on the government as check. This was the main sentence. It was a check on the government that government couldn't print currency any point of time. They needed gold as a backup. And yes, there was a kind of security as well. It was a security amount that government had to keep, right? So it was a secure printing. Means if something bad happened, we had a backup of gold as well. But the new concept that was brought first by USA and then the entire world followed it, it was minimum reserve system. Minimum reserve system means we need to keep some amount of gold and some amount of forex as a backup. Means for example, let's take example of a bucket, water bucket. We need to fill half bucket. Half bucket is the minimum requirement that should be filled throughout always. That the level of the bucket should never go beyond that half level. So what I wanted to say, if the bucket is filled half, I can do whatever I want to do with the extra water. I can print more currency. What I wanted to say, there is minimum reserve of forex or gold. If that minimum reserve is there, government can print as much currency as there is no limit. But if this minimum reserve is hit, the government first have to fulfill this minimum reserve. So let me give you one more example over here. Let's say Mr. Ram is having 10,000 rupees salary, right? And he wanted to go out in a restaurant to have some good, party with his friends. So Mr. Ram has this criteria that whenever his salary, his bank account will be having minimum 5,000 rupee. And if he has anything extra on that 5,000 rupee, he will spend it the way he wants. No limits at all. But whensoever the bank account of Mr. Ram goes less than 5,000, it could be 500 rupee less, it could be 1,000 rupee less. First, he has to refill that. Only then he can buy. This is the system governments of all the world now follow. It is called as minimum reserve. That minimum there should be 200 crore rupees. There should be 200 crore worth of assets with RBI. Those assets could include gold, some heavy and some commodity like silver as well, or forex as well. Forex means international currency, right? So if the minimum amount is 200 crore is there, then government can print as much currency they want. But if it goes less than 150, 200 crore, like 150 crore or 100 crores, then government has to first refill that, and only after refilling that, government will be allowed to print the currency. Now, this is the recent example that happened in Pakistan. That in Pakistan, guys, the minimum reserve went very low. It became very, very low that they had, the minimum reserve was there to just sustain for very few days and few months. So again, it is a good criteria to keep a check on government for, so that they can prevent printing of the currency. I have got the point. So earlier it was proportional reserve system when you had to keep gold as proportional reserve, but today it is minimum reserve system, right? So it was a good system before this, but today the system is more biased towards in the favor of government. Now government is kind of having a free hand to print the currency the way they want it basically. I hope you got the point, everybody. But the printing of currency just comes with one drawback. That drawback is that it will increase the money supply, and because of high money supply, it will increase the inflation in the direction where the money supply will be going. Right. Now, one more question over here. Who has the signature on the notes? So this is a 2000 rupee note. So in the 2000 rupee note, we have signature of the governor of RBI. You can see over here. So all the notes above than 1 rupee, there will be signature of governor, governor of RBI, and only it's the 1 rupee note, finance secretary, does the signature. And why this 1 rupee note is so special? Because we treat it as as you can say, as a heritage. We treat it as a ancient historical heritage. That's why we kept it still alive. Otherwise, we could have abandoned it. But still, it is working just because it is treated as a heritage. Now, the main question that comes is, when you have heard the news and when I started this session that interest rates will go up and interest rates will go down, my my question is, which interest rates goes up and goes down? This is the most important question. Means if we started this topic with a news cutting that interest rates will go up, go down, there will be a cut in the interest rates. What are interest rates? Which interest rates they were talking about, and how it will work? My second question today is, how RBI sitting at the one place, Mumbai, government of India sitting at Delhi, how they regulate the money supply sitting at one place? What are the tools? What are the tools and how effective these tools are? Secondly, how they can suck the money and how they can give back money to the economy. How it is decided. So what interest rate we are talking about and what kind of tools we are talking about. Now we are moving towards the practicality of monetary policy, how it works and how practical it is and how efficient it is. All right. I want you to think and let me know. Now coming back to the same story, this story we had discussed in the previous session as well. Take yourself as a head of the family, father or grandfather. You know, your father gives you money and you and all your siblings are having holidays, summer holidays, right? Now, whenever you will get the money, you will tend to spend the money and you may, end up eating something, pizza, burgers, or some sweets, chocolates. It will spoil your health, right? So when your father or grandfather get to know this thing, they'll tend to take your money back. Now, they can take your money back either by scolding you that beta, you need to give your money back to me. And there is no option, you have to give the money because he's your father, right? Or your grandfather or your father, they may try to convince you morally, beta, it is not right, that you should not spend your money recklessly, your health will get spoiled. So this is something moral guidance they're giving you, right? So they can scold you, they can advise you, they can morally guide you. So this is qualitative mean. Qualitatively, they're taking money from you. So they are sucking back the money supply from you. So once I will take money once the money is taken from back from you by a father or grandfather, you don't have the money to spend. So you can't buy the stuff. You can't buy chocolates. You can't buy burger and pizza. So your purchasing power will go down. And if once the purchasing power will go down, the vendor, the shopkeeper near to your house, he'll have no one to sell, right? So automatically his workload will also go down. So the industries who is supplying products to him, their workload will also go down. This story we had already discussed in the previous session, right? Now the thing is that this was a qualitative mean. Means I am taking money back qualitatively. What if I give you a offer? An offer would be, कि बेटा you give me 100 rupee right now and in return I'll give you 110 rupees after 3 months. It's a good thing. Because anyhow, the money which you will keep with yourself, it will not grow, right? But if you give it to your father, and he will give 10 rupee extra with interest. So this is quantitative, which you can quantify. So these are called as quantitative means. So this time your father is giving you a motivation to give money to him. Again, he is sucking the money from you, but the tool, but the way of taking money is different. It is quantitative. So by all means, there are so many means your father and your grandfather can take money from you. Similarly, if I relate this thing with RBI and bank, RBI is the grandfather and bank is the father of the entire money supply system in the country. So whenever RBI wants to take money from all the citizens, so what RBI would be doing, RBI would be guiding the banks and guiding the citizens morally first. So the RBI will start, morally guiding the banks that money supply is increasing. We want you to suck money back. This could be done, right? Same way. What is happening in the family of grandfather, father, and the siblings, right? Or RBI could, strictly scold the banks that you are misusing the money supply. Try to regulate it. Try to control it. So again, it can be done. Or RBI can come in a media session or in a public platform where they can give a speech. The governor can give speech that inflation is rising and we need people to spend less and all these things. So again, morally it can they can guide it. So this is how RBI can do things qualitatively. There's nothing quantitative yet. Similarly, RBI can do stuff quantitatively as well. RBI is the father of all the money supply system and all the banking system. Now, this time, what RBI can do, RBI can give a motivation to the banks that if not only banks to the citizens as well, that if you deposit your money to the banking system, we'll give you some extra interest. So all the people will there deposit their money with the banking system. Now, the money from the pockets of the citizens, it will go to the banking system. Similarly, banks also deposits their money with RBI sometimes for interest. The bank will increase those interest. The banks will also RBI will increase the interest. Now this time banks will keep giving their money to RBI. So this is how giving them motivation of some extra interest which they will be getting. So they will deposit their money. Citizens will deposit their money to the banks, or banks will deposit their extra money with RBI. So they will be getting some extra monetary benefit. But by doing this thing, the entire you can say money from the economy will be sucked by RBI and the banking system. Again, inflation will go down. So this is a quantitative way. Similarly, RBI can infuse the money supply in the economy as well. It can be done again. So opposite system will be done by decreasing the interest. People will withdraw the money and they will start spending it. So this is also way number one, quantitative way. So there is priority sector lending as well. So let's give you a very good example of priority sector lending in a family. So this time your father and your grandfather, they don't want you to give your money to the father. They want you, instead of misusing the money in chocolates and pizzas, they want you to why not to have a guitar lesson? Why not you join a karate class? Why don't you join some swimming class? So why doing this? They suck the money from you, but they redirect it to a channelized thing. Means they redirected it somewhere else. So they redirected your money instead of taking it back, right? They gave it to swimming class. They made you to give it to a gym class or a guitar class or a karate class. So money is taken from you, but it is redirected at somewhere else. So this is called as priority sector lending. Government also does that. Does that. Government will give some encouragement to the farming sector. The government will give some rebates in that sector. For example, all the farm loans will be having very less interest to be paid. Or all the financial all the industries in the financial sector in the agriculture sector will have less income taxes. So what will happen? Entire money will start flowing in the agriculture sector. So government would like to grow that sector, And for the growth of that sector, government will redirect the money of the economy on that side. Similarly, if government wants to discourage something, and if government wants to discourage specific sector, government will impose extra taxation, like cigarettes. Government will impose extra taxation over there so that people get discouraged. Similarly, recent budget it was for FNO. For FNO, what government did, government tend to impose more taxes on FNO because people were, facing so much losses in FNO. And because of those losses, what was happening that uh, you know, the people were facing a lot of losses, especially the retail investors. And because government wanted to discourage that, government imposed more taxation over there. So this is how government can discourage or encourage any sector by changing the money supply in that sector by changing the interest rates and like that. This is how the entire sector works.